Every time you buy a share of Apple or Microsoft, you are making an implicit claim that the price on your screen is lower than what the business is truly worth. This is Chapter 1 of the Fundamental Analysis module, and it is about the disciplined process of testing that claim. Fundamental analysis estimates a company's true value and then compares it with a market price. Picture it as a set of scales. The fundamentals on one side, value against price in the middle, and the verdict at the end. Start with what goes in. Earnings, the profit it makes. Assets, what it owns. And cash flow, the cash it generates. Set a post in the ground and balance a beam across it. On the left pan, intrinsic value. What the business is truly worth, estimated from those fundamentals. On the right pan, market price. What you pay today, quoted by the market. And those three fundamentals all feed the value side, which produces a verdict. If price sits below value, the stock is undervalued. Where the two meet is fair value. And if price sits above value, it is overvalued, and you may be overpaying. So you weigh what the business is worth against what the market is asking, and the gap is the opportunity. Technical analysis reads the chart. Fundamental analysis reads the business behind it. So what exactly is that value? A stock is a slice of a real business, worth the present value of its future cash, not just a ticker that blinks green and red. So set the two numbers against each other. What you pay on one side, what it is worth on the other. First, market price. It is the number set by the last trade. $150. The number on your screen right now. Ticking along, driven by the moods, forecasts, and liquidity needs of millions of participants. Now, intrinsic value. That business generates revenue, pays costs, earns profit, and over time produces cash for its owners. $200. The present worth of all that future cash. Built from revenue, profit, and cash flow. Put the two on scales. Set the post. And the beam tilts down toward value. Price on one pan, value on the other. Price is less than value. So at 150 against a worth of 200, the stock is undervalued, and that $50 gap is the margin of safety. In the short run, price can swing far above or below intrinsic value because fear and greed are powerful. In the long run, it tends to gravitate toward the actual economics of the business. Price is what you pay, value is what you get, which sets up the oldest argument in markets. Two schools. One studies the market, the other studies the business. Put them side by side. One studies the market, the other studies the business. On the left, technical analysis. The chart, price and volume. Candles, drawn out over time. It looks for patterns, trends, and momentum. It largely ignores the company itself and focuses on the behavior of the market. Its question is, what is the price doing? Set against it. On the right, fundamental analysis. The business, what it earns. An income statement. Revenue of $100 million, net profit of $18 million, free cash flow of $15, from which you estimate what it is worth. It looks at revenue, profit, cash, and competitive position. It largely ignores the chart and estimates what the business is worth. Its question is, what is the business worth? They are not enemies. Many investors use fundamentals to decide what to buy and technicals to decide when. The inputs differ, financial statements and industry data on one side, price history and indicators on the other. And so do the horizons. Fundamental conclusions play out over months and years, while technical signals often target days or weeks. There are two ways to organize the fundamental work itself. There are two broad ways to organize fundamental research, and they differ only in where you start. Same building blocks either way. Top-down starts big and narrows to one stock. You form a view on the economy, interest rates, inflation, jobs, the federal. Then you narrow to a sector or an industry, and finally to a company within it. Bottom-up runs the other way. You start with the business, admiring a membership model or a payment network, dig into the numbers, and only later widen out to consider whether the wider economy helps or hurts. Economy, sector, company. The same three blocks either way, in opposite order. In practice, most thorough analysts blend both. They understand the macro backdrop, but ultimately they buy specific businesses because you cannot own the economy. You can only own shares of individual firms. So who actually works this way? Fundamental analysis is the toolkit of people who buy the business, not the chart. For groups lean on it. 1. Long-term investors. The Warren Buffett archetype. They read annual reports, prize competitive advantages, and hold for years or decades. 2. Pension and mutual funds. They manage huge, long-horizon savings, so they value a business before they buy it. 3. Equity analysts. The research desks at banks and firms. issuing valuations and price targets. 4. Company and acquisition buyers. Firms buying whole companies, who must know what a business is truly worth. And there is a shared thread running through all four. They all ask what this business is worth, and they act when price sits below that value. Short-term and day traders lean on technicals and news instead. Though even a chart trader often watches the fundamental calendar because earnings reports, guidance changes, and regulatory news can move a stock violently in a single session. Different players, one habit. Value the company first, then let price decide whether to act. The raw material is public. In the United States, companies file quarterly and annual reports with the Securities and Exchange Commission, free to read on the EDGAR database. The annual report, Form 10-K, and the quarterly, Form 10-Q, are where the real numbers live. But none of it pays off without one more thing. Buy a business below its worth, and nothing forces the market to agree tomorrow. Patience is part of the method. So look at what that takes. Price against value over time on one side, and the temperament it demands on the other. Two halves. Set up the axis. Here is the value line, the intrinsic worth, climbing steadily. And here is price, swinging around it. Value ends up here. And at some point, price catches up to value. Value is the intrinsic worth. Price is what the market pays. Along the bottom, the horizon. Months, running out into years. And this is illustrative, not real data, which demands four traits. Patience, because value takes time to be recognized. Discipline, stick to your estimate and ignore the noise. Humility, be willing to admit when you are wrong. And independence, which often means acting when others are fearful, because sometimes your estimate is wrong, and then you have to admit it. The edge is not just the analysis. It is the temperament to wait for it to pay off. One reminder before we go on. No analytical method removes risk. A careful estimate of intrinsic value can still be wrong. Businesses do deteriorate, and markets can stay irrational longer than you expect. This improves your odds. It does not guarantee outcomes, and it is education rather than financial advice. Next, we look at the gap between value and price, and the cushion it buys you. You just finished Chapter 1 of the Fundamental Analysis module. A stock is a slice of a business. Intrinsic value is the present worth of its future cash, and the gap between that and the market price is the whole opportunity. Thank you for watching Trendly Lab. Next up, value, price, and the margin of safety. The cushion that separates a good business from a good investment.